Hey, everybody, how are you? Hey, Paul, how are you? Can you hear me?
Oh, we're live.
We're live. Paul, how are you?
I'm wonderful. How are you?
Folks, we welcome you in. There are so many new faces in our group. Paul, we keep saying how funny this growth has been. We started this year, January 2020, with 87 whole subscribers. A lot of times, you and I were doing podcasts basically for our own fun down in the studio. And now we will most likely hit our 8,000th subscriber during the show, if not already. We're so close. Folks, we were going to thank you when we hit 3 and 4 and 5 and 6 and 7, but it happened so fast in the past week. Paul, what has our past week been like for you, and just your thoughts on the show, these amazing subscribers?
Yeah, it's been awesome. I mean, just watching it every day, every time we refresh, there's more subscribers and patrons and everything like that. And we do this anyhow. We don't care if there's 8,000 or 8 million, but obviously it's nice to have 8 million at some point because we want to do a lot more, buying more real estate, doing more things, showing more stocks. I mean, the more subscribers we have, the more we're going to invest back in the channel to make it better. But it's been awesome. I mean, literally from last week to now, we have 50% more subscribers. Look, 1 minute into the show, we have 64 watching when, that was a record for us just 3 months ago. When did we start doing live streams?
Paul, I was going to say, if you recall, guys, none of you were on this. None of you were with us. But 2 years ago in October of 2018, Paul was going live. We were funding projects where you would go live and discuss real estate, and we would get 7 watchers, Paul. You remember those days where you would pump money into advertising? We would get 7 people watching, and 3 of us were just our friends. So it's just amazing. Yeah, I see you guys. I see you guys in the comments. It's incredible. Some of our OG patrons are there. Llewellyn, I see you, my friend. Obviously, David Angelos, I see you there, and a lot of new names. So welcome you guys in. A lot of the new patrons, Paul. The Patreon is going nuts. 124 patrons. The Discord channel is off the hook. We will get into all of this. Stay tuned, guys. Paul, I think we'll go about an hour today. I'm in Ohio, in the cold of Ohio, building snowmen with my family, and Paul is in his. Are you chewing your nails right now?
Yeah, because
Are you nervous?
Hang on a second. Mira El Pipi is saying that if I point the microphone to the ceiling, it'll sound better.
I'll give it a try. He said that's a blue mic, right? Paul is on location in Mexico, in his Mexico villa down there on the Pacific. It's gorgeous. We'll be joining him on Saturday, so we will be going live next week in Mexico. Great, Paul. How's that microphone sound now?
How does this sound?
That sounds fine. You sound great. Yeah, there you go. Great. There you go. You sound good. Guys, let's get after it. What are we going to do today, Paul? We are talking about the winners and losers of the stock market in the year 2020, this past year. Paul, what a year. I don't think you and I were sitting in Mexico last January, and obviously no one could have come up with what this year has been like, with just the absurdity of both the market, obviously COVID, the presidency. It's been a wild year, and I think things are looking bright. But we definitely have a lot of winners and losers from the year, which we will get into. We will look at Fiverr, Peloton, Zoom, Novavax. Paul, I don't know anything about this company. Of course, we'll take a small look at. Is your fly down, Paul? What are you doing there? Your fly is down, Paul. I knew it. See,
no, my fly is not down. It's the strap.
What are? Oh, yours is shorts, right? That's right, because it's shorts weather. That's right. Paul's super shorts are back because he's in 70 degrees while we're squandering here in 20-degree weather.
It's 80 degrees. It's 80 degrees here.
Oh, of course it is. And we will also look, unfortunately, at Tesla today. I say unfortunate because I know where Paul's stance is on this company. It's been very standard on Tesla for a long time. So. As always, guys, I have a list of our Patreon requests, so I will get to all of these today. If you have some requests, you're welcome to put them in there, but we usually pick some Patreon members first. So, Paul, should we get into our 8-pillar analysis and looking at some companies? Do you have anything to say?
Comment first?
Go ahead, Paul.
In a very rare show, Seth and I found a stock that I liked, H&R Block. Mo is currently researching it. I actually started a position on it today and also started to start some puts on it today. H&R Block is selling for about 5 times free cash flow. I don't know why it's not being looked at. I think it's because of 2020 being so bad for it. It's down a lot from its high of 3 years ago. So I'm looking at H&R Block more. I think it's worth like, mid 20s to $30 a share from my buy. So it's selling for $15 a share. I'm going to be building a position, I think, on it.
Yeah, guys, we just did a few videos. Paul and I recorded some videos. We looked at Disney, we looked at Netflix, which is obviously very popular, and we found H&R Block, which doesn't have a spoiler alert. H&R Block, its current market cap is half what Paul thinks it should be, which is very rare for this show. So, Paul, why don't we get into it? As always, guys, we welcome you in. Make sure you guys are doing a great job of smashing that thumbs up. 75 watching, only 30 thumbs up. So give us a little love. Just give it a little tickle there, Paul. I'm sure you love getting tickled in your love life. You look like a guy that likes getting tickled. Yes. So, just tickle that thumbs up because Paul really loves that. So, and unfortunately, I just said that my child is watching. George Krichanen, my 10-year-old, he's watching. I love you, Gio. You're there. Okay, guys. I see you all there. David Spicer. Yes, I see you there, guys. Here we go. Paul, should we look at Fiverr first? This is an interesting company. Ali, all of our thumbnails with our big head, awesome thumbnails were created by our producer, Don. We love you, Don. All of those are made by a guy on Fiverr. I found him many months ago, and he's been helping us out. So so Fiverr's great, Paul. What do you think of Fiverr? Do you use this? You do use this company, of course, right?
I do use Fiverr. I found you on Fiverr, I think. So
you found me?
Helped out a lot.
Yeah, I come very cheap. If anyone needs a podcast host, I am on Fiverr. I can do this for a living. So, Paul, why don't we look at what's going on with Fiverr? What is the market cap for this puppy?
All right, is my screen shared?
Yeah, go ahead.
All right, well, look at this first off, the chart. I mean, it was the market downturn. It was at $23 a share. Now it got as high as $223. That's 10 times more in a matter of 8 months. A $6.8 billion company. It was $680 million just 8-9 months ago. No PE, big X there. Not a shock. New company. I thought it would be a money loser to start. It lost $14 million in the last year. So it has a negative profit margin. So 2 X's to start. But look at this gross profit, Seth. 83% gross profit. That's pretty high.
Wow. Okay. Pillar number 3 is revenue growth. Paul, we want to see that revenue growing over the past 5 years, baby.
Well, they don't have 5 years of history. They have 3 years. We have 52 million to 107. And in the last 12 months, we've gone 163. So it's growing quite fast. That's a definite big check mark there.
How about profit growth, Paul? Pillar number 4.
Profit growth is an X here because it lost 19 million and then lost 33.54 million. In the last full year. But let's see the last 12 months. It has only lost 14 million. So you can make the argument it's a check, but we'll still keep it as an X just because we're trying to stay consistent.
Okay, how about pillar number 5, Paul? Is shares outstanding. Folks, we want this number going down.
Now, I don't know if you see it, but 25.6 down to 20.5 million shares. So that's a check mark there. Are
you surprised they're buying shares back already, Paul?
For such a big jump, that quickly, I don't know what they did, but that is kind of surprising. Who knows what happened?
All right, how about pillar number 6 is current assets greater than current liabilities, Paul?
All right, 312 million in current assets. Liabilities, now here's the good news. Total current liabilities, 126. All liabilities, 130. So they have enough money by far to pay off all their debts completely, not just the current ones. This is what we love to see. It is hard for companies to go under when they do that. So you'd subtract $200 million off their market cap, which isn't much because they have 6.5 billion. So whatever.
Okay. How about pillar number 7, which is free cash flow growth? Did they have a dividend, Paul? I didn't even look.
They don't have a dividend.
Okay, keep going. Free cash flow growth.
Their free cash flow went from a negative 8.5 to a negative 15.6. So that's an X. And there is no free cash flow. So another X for the price of free cash flow. Guys, you know what I'm going to say to this one. This one's a hard one. I mean, price to sales of 40-1. I'm avoiding this at all costs. Let them grow. Let them be big. Let the stock go to 2,000. I know it sounds crazy. I'd rather the stock go to 2,000 and it be worth 2,500 and me buy it then than ride it from here to 2,000. I just don't. I'm not buying into this one right now.
Guys, we're currently talking about Fiverr. We're going over the 8-pillar analysis. They have no PE ratio. Their profit margin is under 10%. They do have revenue growth. They do not have profit growth. They are buying back shares, and they have great assets over liabilities, current assets over liabilities. But without that free cash flow and the price to free cash flow, our last 2 pillars, Paul, this is basically a hype stock, right? I mean, this is just like really based on.
It's up 10 times. It's up 10 times in 8 months. I mean, there's only so much you can do with that. You know what I mean?
This would be the opposite of buying low and selling high. This would be buying high at this moment. So it's a bit hard no on Fiverr. Yep. Guys, we welcome you all in, the new viewers. Make sure you're smashing that like. We see that you guys are all over the world. Paul, aren't you surprised that people all over the universe are tuning in? It's just amazing, you guys. Make sure if you haven't yet, go ahead and put in the comments where you're from. We'd love to know. Paul, don't we have some folks in Fiji?
We have somebody from Fiji. At the very beginning, they said, "Hey, hi from Fiji." I was like,
amazing. And one of our patrons, Phoenix, I see you there. Some people are very happy finally catching us on the live stream. So, and Tony, I see you there.
Edward Francis and Edward Donaldson are close to each other. Liverpool and London.
Oh, Netherlands, Jordy. Look at that. Chris Llewellyn. Yeah.
Toronto.
Yeah. Oh my gosh, guys, that's incredible. Look at that. Oh, Tomas.
London.
Wow, Norway. Wow, incredible, guys.
Everyone's foreign. No one's from. There's my dad.
Paul, there was your dad. Get him on the show. Dr. Gabriel, get him back here. Get him on the show. This is a first, folks. Paul's dad.
I don't think my dad.
Get him on the show, Paul. I insist, and so do our viewers. Watch the chats flow in. Here they come.
He went to his room.
All right, he's gonna have to, folks. You have to see what Paul's gonna look like in 40 years from now. So we got to get him on.
But the thing is, I don't look like him now. Like I don't look like he did at 39.
That's how you're gonna look, Paul. We all know this. So okay, Dave, we welcome you in. Husky, good to see you. All right, guys. Paul, I'm guessing with a lot of these winners, they're gonna be no's, but it's also a good way to look at what are no's, so you can know what are good. So the next company, which is very popular. Yeah, see, look, Paul, they're going crazy trying to get Dad on the show now. So,
hey, Dad, we're live right now, and people want to see you.
Get him up here, guys. This is Dr. Gabriel. He owns
people who are fans of our show. We have 91 people watching.
He owns Gabriel Cancer Center, and Doc. He's hey, Doc. Good to see you, Doc.
Hi, Seth. How are you?
Good to see you. I won't see you on Saturday when I come in. I guess you'll be leaving, but it's good to see you.
Yeah, good to see you then.
They're going to play golf at the worst golf course in the world. When are you leaving?
Maybe half an hour.
Dad got the vaccine, by the way. Which one was it, Moderna? Dad got Moderna vaccine stuff.
And Dr. Gabriel, you're still on the hydroxychloroquine, right? You love that stuff.
I stopped it.
Oh, you stopped. Yeah, I see. I was at Doc. Thanks I took my whole family to get tested down at your hospital last week. Thank you for that. We appreciate it.
I saw you in the driveway.
Yeah. I've been there a couple times now. So anyway, thanks for coming on the show, folks. There he is, Dr. Gabriel. That's Paul's dad. And there's Mo. There's Mo right there. All right, guys, we should get back to it. Everyone loves Dad, but you're right. Hey, Mo, good to see you. I'll see you Saturday, bro. Hey. All right, guys. Now that you guys saw Mo on the live stream, of course, if you're a Patreon member, we will be going live from Mexico, Paul, myself, and Mo, for an uncensored Patreon-only live stream. Paul, I would imagine we'll go for at least 2 hours or something crazy to answer all of your questions. So let's get right back to it. Yep, let's get right back to it. Pelotons, Paul. I know you don't have a Peloton bike. You're not into biking.
But Mo and I, we're each buying a Peloton. So I have 2 commercial treadmills at the office, but Mo was like, hey, come join me at Peloton. I might be buying a Peloton. I was like, cool. I went there. I love it. The Peloton, it's got the big screen. there's a hack you can do to go on the internet so I can play chess on this big screen while I do the treadmill, I'm definitely gonna be buying a Peloton.
Oh, Paul, we do get a lot of comments now that I'm seeing is everyone wants you to grow that similar mustache. So,
my mustache would not be the same quality level as Dad's.
I don't know, though. I mean, let's give it a try. It looks pretty thick right there. I mean, you got a couple days stubble on there. So, all right, let's get into it. Peloton stock. What is the market cap for this biking company, Paul?
Well, first off, look at the stock chart. It was at freaking $19 a share back in March, and now it's $150. So the market cap is currently $43 billion. PE ratio, look at that PE ratio, Seth. What do you see there?
Wow. So guys, again, I'm coming at this as sort of a newbie in investing, of course. I've only been doing this a couple of years, but we want, for pillar number one, we want our PE ratio less than 20. That's not 20%. We just want that multiple to be less than 20. And this one is 530. Now, right off the bat, Paul, that just, do we need to look any further at some of these? I mean, right off the bat, that tells me that
well, let's just look at Peloton. I want to make an announcement. We just hit 8,000 on the nose.
Oh, wow. Congratulations, Paul. 8,000.
Yeah. You too, Seth. We just hit 8,000 subscribers on the nose.
Incredible. Thanks to all you who are watching. You guys are incredible. Paul, go ahead. Let's look at, let's go back to Y charts and look at, so pillar number one is an emphatic X. Pillar number two, how is their profit margin on these bikes?
So the profit margin right now is only 9% to the bottom line. I'm even surprised it's that much because look right here in the trailing 12 months, it's only been like 2%. So that's kind of interesting. But the gross margin of 43%. And one of the big things for them is they're trying to build not just the revenue from selling their equipment, but their recurring monthly revenue. Like you have to buy the monthly plan in order to get the classes and things like that. I think it's like $40 a month or something like that.
That's a hell of a business model, right? I mean, that's a hell of an idea. Yeah. When people do this, I'm a wedding photographer and I bought actually right next to me, I bought it's a photo booth, Paul, and I thought it was a one-time buy. Sure enough, I'm paying a monthly fee on this to have this subscription. So everything's going subscription-based. I think they did a great job with people who are into that. That's a great job to be able to bike around and get money to the company, right? I mean, it's great.
Oh, absolutely. But look at their revenue growth, Seth. You see this? This 216 million in 2017, 1.8 billion this last full year. I mean, that's incredible. Now,
this is probably reflected in their marketing too, Paul. Those commercials are all over the place at Peloton.
Oh yeah, and they're awesome. They have hot chicks and everything. It's great.
Yes, and men, and men, Paul, and hot men.
Oh yes, men too.
Okay. Pillar number 4 is profit growth, Paul. Go ahead.
So their profit is a negative 71 million to a negative 71. It's still an X barely, but they're losing less percentage of their revenue, which is good. So they're getting closer and closer to operating profit. Shares outstanding, check mark, from 233 million down to 221.
Paul, Bogdan is one of our patrons. Bogdan, we welcome you in. He said the PS ratio is only 18, Paul. And Bogdan, real quick before you answer that, Paul, Bogdan, we did analyze a couple of your stocks that you suggested. We're going to come out later this week with Netflix and Disney. So we appreciate you being a Patreon member and giving us some awesome stocks to look at. But Paul, what do you think about that PS ratio?
That's a high price to sales ratio. That's a really high price to sales ratio. As an example, if you want to look at, either way, that's a high. I don't like the price to sales ratio. I didn't bring it up, but it's a very high price to sales ratio.
And Social Dancers, our gal from Toronto said, Paul, can they stay at this rate when the pandemic is over?
That's a good question because I think a lot of the revenue has been driven because of the pandemic. I mean, the fact that people have been forced to stay home and gyms have shut down. I mean, when we went to go look at the Pelotons, they basically told us we were 60 days out to even get ours. So, it is a different world out there. And the goal they have is people buy the machines, they take them home, they love them, and then when the shutdown's over, people still use them because they're like, hey, I still love this machine. I got used to it. It's like a new lifestyle kind of thing.
Paul, let's look at pillar number 6, which is current assets greater than current liabilities.
Current assets, 2.6 billion. One of the things I want to note, inventory is part of current assets. And I like the fact their inventory number isn't as high a percentage of their current assets. That's a good thing. And I believe Peloton builds upon orders. So they're not trying to hold a lot of inventory, which is good. So again, 2.6 billion in cash on hand, 1.0. Oh, guess what we have here? They have more cash on hand than total liabilities. Check. That's awesome.
You love that. Travis said, is it worth being a Patreon? If you're Travis, that Patreon channel is buzzing all day and all night. Paul is on it. all the time. And so there's other patrons in the channel here. They can certainly agree that thing is buzzing, and you'll get a lot of questions answered if you want to be a patron.
Not only that, when we have the 8-pillar stock website done and these financials, you're going to get all that for free as long as you're a Patreon member. So the worst case scenario, you pay $8 a month right now to get something that you'd be paying $25 a month in the future. And it'll give you all your stock analysis, and it'll give you all your 8 pillars immediately upon entering the ticker symbol. So if that's not worth it to you, I don't know what is.
Now, David Spicer, a longtime OG, Paul, he is saying for only $8 a month, you can listen to him rant about all things religion, politics, and investing. For David, we know we love you, David. Paul, let's get back to it. We were doing current assets over liabilities, which was wonderful. How about free cash flow growth, which is pillar number 7?
Yeah, free cash flow growth is actually really good. They went from losing 28 million in free cash to gaining 220 million in free cash in the last year, and then in the last full year. In the last 12 months, they've done 550 million in free cash flow. It's still not good for their value, but that's a definite check mark there. They're definitely generating free cash flow now. This is good.
How does that translate into price to free cash flow, Paul?
They're at like 100 to 1. So it's definitely an X on the price of free cash flow. I don't think Peloton is for me at this price. The good news is, would I bought it somewhere lower? I mean, at some point this year, I'd have been a buyer of Peloton based on current numbers. This is all momentum here, guys. This is all based on hype and euphoria. There's no way you go from $19 a share to 150 and 163 in 1 year based off of fundamentals. I mean, that just doesn't happen. So let's figure this out.
Yeah, Tomas brings up an interesting question. It'd be interesting to see how much of this is coming from the bikes and how much is coming from subscription. So,
well, I don't think you can get subscription unless you have the bike, and I think
of
the
course
goal is that subscriptions are the main driver. But that's a good question, and it's something that the 10K will probably have in there.
Paul, should we move on?
Yeah, let's move on. And by the way, the price of sales of 18, that's just bad. Bad.
Paul, I'm so fired about 8,000 subscribers. That's incredible.
On the nose. I love it.
In January, I bring this up a couple times, folks. In January, Paul said his goal was 10,000 subscribers. I did not see that. I did not see that as a possibility at the time. We talk all the time. Last Christmas, we were sitting around, and I had a dear friend of mine say, "Why would you guys do a podcast that only gets 17 views on YouTube?" And it really has driven me to be like, we had to get 17 to get 18, and sure enough, now we got 110 people watching. It's just been quite incredible. So, we thank you guys for your. You guys are really committed to our channel, and the Discord. The patrons are incredible, Paul, and we can't thank you guys enough. Tony, I see you there, and Ariane, I see you there. Paul, should we get going with another stock? How about Zoom, Paul? We've talked about Zoom before. You want to get after it again?
Yeah, let's go to Zoom. Oh, Zoom, huh?
Yeah, Zoom. We're not using Zoom right now, but let's get after it. So, Paul, we did a show on this many months ago, and when it was completely spiking. And look at this now; it's dropped down a bit.
So, guys, I want to show you. If I told you at this point,
that's right,
that the stock was going to fall 40%, what would you have thought?
It's not possible.
Oh, Paul, you're crazy. Yeah, and look at it; it's down like 35% right now. So I'm just telling you guys, like, these things happen. This is only literally 2.5 months ago, and it's down 35-40%. Like, you got to just be patient sometimes. The great news is there's 10,000 stocks in the US for US-based companies. Be patient and find 20 or 30 that fit your criteria, and find 100 more that you love that just aren't selling at the right price. That's it.
Tank is saying that Zoom had some problems in Germany before. Paul, I have another thought after this. Gosh, Paul, I want to bring something up, and I want to bring this up afterwards.
Bring it up now before we get into Zoom. Bring it up.
Well, you know what, guys? I'll tell you what. If you follow our channel and you love us, we appreciate it. But wow, look at that, Paul. Sorry, let me get you on a different camera. I have to be honest, guys. If you look at other people who are getting really successful on YouTube, they do a lot of fluffy videos on hype stocks. They put the numbers 20x, 10x your money. All you have to do is listen to them, throw your money in, and you're going to make a jillion dollars. You're all going to be millionaires just listening to them. And then, of course, a week later, they start talking about the crashes that are happening with the same stock. So it's like Paul has been very diligent in following sort of a turtle versus hare type mentality. we're going to stay to we're not going to do those flashy hype stocks, and we're not going to push you towards something that we don't believe in, Paul. But along these similar lines, we have one of our patrons, Gavin, who does really well by pushing Webull on his TikTok. And so, Graham Stephan, some of these other big financial people who make videos, they push Robinhood, they push Webull, and they make a ton of money off of this. And sure enough, just this week, Paul, last week we argued because you were very much against this. And sure enough, tons of allegations are coming out against Robinhood. Did you see these news stories?
No, what were they saying?
They're getting sued by people saying that the expert analysts and advisors through Robinhood were pushing people to stocks that didn't make any sense. Sometimes the numbers weren't matching up. There's lots of news stories out there, but of course, I was
surprised about.
Go on.
What surprises me? Usually that happens after stocks fall a ton. That doesn't happen usually when stocks are up a lot. So that's what's surprising me. That just shows you how bad it is.
Yeah, I just saw this, and I don't know. It was funny because I was pretty. Yeah, Robinhood settles charges over misleading customers. Robinhood to pay $65 million fine. They were misleading customers. It's just funny because I was pretty much just upset with you that we weren't following the trend of what other people are doing.
You were upset with me.
And what did you say?
You
You said, I don't trust Robinhood. I don't trust Webull, and we're not going to try and make money off of our followers because of that. So it's just
by the way, not only that, it's funny. Somebody accused us recently of only being a Patreon advertisement. That was funny because every other person out there is trying to sell 18 different things in their show. We have other businesses that generate our cash flow. So to us, we do this because we want to do it. So we do this because we want to. If I ever plug something, it's because I believe in it and I already use it. We put a Charles Schwab link at the bottom, and guess what? I don't get paid for that. You get paid for signing up with that. Depending on how much money you put in there, they're going to give you up to $500 to open a Charles Schwab account. I don't get $1 of that. I'm fine with that because I want to make my money off of YouTube and Patreon and our app that's providing a lot of benefit for everybody. That's just how I choose to make my money. Somebody else wants to plug Robinhood and Webull, more power to them. It's just not for me.
Guys, I love the great comments. Chris Stupas is saying if we were a stock, we'd be a growth stock. Paul, that might be true actually. So, but yeah,
true.
We see you guys.
And hopefully we wouldn't be overvalued, but we might.
Yeah.
Be.
Yeah. All right, guys, let's get into what the heck were we doing, Paul? Thanks for that. Zoom. Let's get after it, Paul. What is the market cap for Zoom, baby?
$100 billion with a 246 PE. That's a kind of a big X right there. But profit margin's huge, 25%. So we have an X on the PE. We want it to be around 20. It's 246, so it's 12 times higher than it should be. And we have a 25% profit margin. That's pretty good.
Pretty good. Okay, how about revenue growth over the past 5 years is pillar number 3, Paul?
I'm quite sure this is going to be insane.
Yeah.
So 60 million to 622 million, 10 times more. Check mark.
How about profit growth, pillar number 4?
Basically break even to only profit of 25 million on $660 million there, but that'll probably, so that doesn't include the shutdown. Let's look at including the shutdown. Wow, $427 million they made in the last 12 months, guys. That's insane. That's awesome. Good for them.
How about pillar number 5, Paul? Is there shares outstanding? We want that going down, baby.
It is going down. 237 million down to 233.
That's nice, right? Great.
Yeah, that's very nice.
Okay, current assets over current liabilities, Paul.
I imagine this is going to be good as well, Uncle Seth. So current assets of 2.6 billion. Okay. Why is this not? Okay, there we go. 2.6 billion. Current liabilities of 1.4. So check mark there. In fact, total liabilities of 1.55. So quadruple check mark there. They have more cash on hand than liabilities. And I usually subtract this number. It's about $900 million from the market cap, but the market cap's 100 billion, so it doesn't really matter. It's only 1% difference. This company is still massively overpriced.
Kate's asking, is this information available to the patrons? Kind of. Well, I mean,
it will be very, very soon. We're building the website as we speak. I speak to the developer almost daily. This will all be available very soon. The second it's available, the lowest Patreon will go away and it'll become a much higher Patreon level because I want to reward people who dedicated their time and money to us up front. So if you want this information in the next 3 or 4 months at $8 a month, sign up for the Patreon now. If you want it for $25 a month, sign up later. It's your decision.
You were banging that table a lot there, Paul. You're very passionate about this.
Because I, you know me, I don't like to sell, but when I believe in something, I'm going to pound it. And this is where I believe in. Like, You literally, if you think you want the 8 pillars and our data are there, you are crazy for not signing up for the Patreon right now. And you're going to be around people who all talk every single day about stocks.
Should we keep going with the stock, Paul? I mean, it's
no.
crazy.
Let's just sit there and say, guys, Zoom, I'm a no on for a while. What price? I don't know. A lot lower, like a lot lower. I mean, maybe 10 billion, 90% drop or something. I don't know. It's really bad.
I think you guys are in for a treat. This is one of the hottest stocks we've talked about all year, and it's Carnival Cruise. Paul, I'm going to skip off the winners table because they're all just basically currently overpriced. But why don't we look back at Carnival Cruise? This has been one of your favorites. I invested in this after our Carnival Cruise video we did many months ago. My son loves Carnival. Some of our patrons have made a slaying on Carnival, but Don gave us that this was one of the losers of this year. I'd like to look at Carnival one more time and get your thoughts on this company.
So I'm not gonna. Here's the deal about Carnival. Carnival and Southwest. I didn't do a. I'm not going to go through the wide charts because it's so bad. It's more of a 500-foot view. Carnival has plenty of cash to support about 10 or 11 months more of shutdown. The vaccine is out. They have plenty of cash. They're the world's largest cruise line, and they have the least amount of debt relative to their revenue out of all the major cruise lines. So my thought was, are cruise lines going away? The answer was no. Okay, who do I want to bet on? The one with the least amount of debt. Well, the one with the least amount of debt happened to also be the biggest one in the world. So I was looking at going, okay, so if I'm going to bet on any one of them to make it, which am I going to bet on? And it was Carnival. Now, the next steps were the whole cash on hand. They're generating good cash. Yes, they are diluting investors by issuing shares to pay for that cash flow loss, but I'm okay with that because I had their value originally at $50 or $60 a share. And even with the extra dilution, it takes them to $45 to $55 a share. I'm still okay with it. It's still selling for low 20s. I'm still a holder of their stock, and I will probably keep holding it until it sees the full value.
Paul, Tank from Germany said, can we discuss some oil companies? And the next one I had on my list was Occidental Petroleum. Do you want to look
Remember, I do not do energy, which includes oil. I don't do utilities. I don't do banks or insurance companies. And the reason being is for oils and commodities, their prices fluctuate. Their profit numbers fluctuate way too much based on commodities prices. So I avoid them completely unless there's some extreme circumstance that happened, like BP back in the day when the oil spill happened. I was like, this is a no-brainer for me, and I bought it. For banks and insurance companies, the typical cash flow is not looked at the same way. They make money, CMO, they make money in a different way. So I don't look at them. I'm still learning banks and how to learn how to value them, but it's not the typical way. We don't look at free cash flow. We don't look at current assets. It's a totally different method for looking at banks and insurance companies.
Paul, what do you think about gold and silver moving forward?
I'm a fan of gold. I have gold mining ETFs, GDX and GDXJ, because I can't value gold companies, commodity companies very well. I buy the entire industry. I just think gold will be very popular if the market goes down. And if I believe the market's as overpriced as it is, I think gold's going down. So I'm a big believer in gold, and I choose to invest in it through the miners, through GDX and GDXJ.
Guys, Paul, we have some requests for NVIDIA. I had it on my list as well. Do you want to look at this? Is off the Patreon request line, and some people in the comments are asking. So we appreciate the comments.
I haven't looked at NVIDIA before, but
yeah, let's put up right now for our live viewers. NVIDIA, what do they do again,
NVIDIA,
Paul?
$320 billion company. Okay, 320 PE. Ooh, 85. What happened there? Are they up a lot this year? Oh, geez, they're up a ton this year. So their PE is very high, 85. But profit margin, big check mark, 28% with growth margin of 63. So that's really good. So they have an X on the PE, but let's see, there could be a reason why the PE is very high. Maybe they had a big write-off or something. Look at this adorable dividend stuff.
Adorable.
Why even send a dividend check out, you idiots? All right.
Okay, how about pillar number 3 is revenue growth over the past 5 years, Paul?
It's doubled, but from 5 billion to 11 billion. But I'm willing to bet there were some acquisitions in here that made this big jump here. So we'll look at that. But remember, there's two ways of growing: organically through your own, internal growth, or making acquisitions. Of course, I want the business to internally, organically grow more than acquisitions. But technically, it's still a check mark. They still did grow over the last 5 years. Net income,
Sorry, Paul. I was just going to say, guys, if you're watching this on replay or another segment, we take these requests live. So we have not done a full study on these companies. I wouldn't come to this channel for info about what the company is doing. We're just specifically looking at financials and the health of a company. Keep going, Paul.
Okay, so their profit, 614 million to 2.8 billion. So definite check mark there.
Yeah, that's incredible. How about shares outstanding? We want this going down.
Now, consistently growing their shares outstanding here. Not by much, but they are up about 10%. So remember, before, if you owned one share, your shares now buy about 10% less of the company than it did before. So they are diluting minorly in the last 5 years.
Paul, Augusta brings up a good idea. He or she wants to look at eBay next. I'd love to look at eBay. I love that company. But let's keep going, Paul. Number of shares outstanding is an X because it's increasing. That's bad. How about pillar number 6 is current assets over current liabilities? Go ahead, Paul.
All right, 14.4 billion in current assets, current liabilities. Wow, 3.7. Definite check mark there, and 11.55 in total liabilities. They have $3 billion more than their total liabilities, and it's not much. It's about 1% less than the total market cap. So that's really awesome. They have more cash on hand than all liabilities total.
How about free cash flow growth, Paul, which is pillar number 7?
All right, you ready?
I got
it. Definitely a growth from 1.1 billion to 4.3 billion. So 1.1, 4.3, 3.1, 3, 1.5.
Average is 2.6, Paul.
Now, there's a lot of growth in the last 5 years in their free cash flow. So 2.6, you said, what was it, 2.6?
2.6, yeah.
I might multiply this by a bigger number than 20 because the growth has been a lot. Now let's look at their, oh wow, they didn't make any acquisitions? What? That was all organic growth, guys. How? Can somebody please explain this to me? So here's the line in the cash flow statement. Remember I said before their revenue jumped up a lot, so it's probably acquisitions, but there were no acquisitions in the last 5 years, 6 years. So anyways, Seth, maybe this is worth 25 times free cash flow because they're swayed in the last, what is 25 times the free cash flow?
25 is 66 billion.
Okay, and they're at
their market cap is 320.
No. Their average was 4.
No, their average was 2.6, Paul.
Oh, 2.6.
Yeah.
Oh, geez. Okay, let's go to the last 3 years then, because they jumped up. So 3.1.
Oh, David is saying they released 30 new the new 30 series graphic cards.
Oh, wow.
Didn't they take market share from Intel?
Maybe so.
Oh, yeah. And look at this. David said in the last few years, they've been selling cards to mine Bitcoin, of course.
So this is an interesting one. Let's go to my sheet here. Can I share my sheet real quick?
Yeah, go ahead, Paul.
Let me go to my sheet, share application window. All right, guys. So if you guys remember, this is my sheet that talks about the stock. So the revenue growth has been 34.3%. That is probably not sustainable. So I'm going to push that down to 50% on the high side. It might even be lower than that. If I want 10% NPV, 15, keep the profit margin the same, I currently have a price of 175 for the stock, and it's at 516. So it needs to drop a lot. But that makes sense. It needs to be a 70% drop because currently the PE is 85. So that does make sense if that's the case. And that's still assuming 17% revenue growth a year for 5 years. I don't think that's sustainable. So really, guys, I hate to say it, I'm looking at the stock under $100 a share probably.
Yeah, it's currently at 516. Yeah, it's currently at 516, and even in the depths of COVID, it was 196 in end of March, $196.
Oh, good. So it's still, guys, this is a great company financially. Obviously, they're doing a great job, but I don't think 34% revenue growth is sustainable over long periods of time for this company.
What do you expect for normal? What do you expect for normal revenue growth?
For a company this size, maybe high single digits, maybe like 7 to 10% a year. Look at Apple. Look at Apple, an absolutely dominant company, and look at their revenue growth. Let's look at Apple here. Apple's revenue growth in the last 5 years has been 12.9%, and they're not even 5.7%. That's Apple, and Apple's dominant.
Yeah.
You there, Seth?
Yeah, I'm here. I'm just Yeah, you're right. I'm taking that in when you say a company needs 30% growth and Apple only has, what do you say, 10 or 12? I mean, I'm just like, yeah, everyone has that.
No, Apple was 5.7%. That was premature for me to say 12.
Oh, wow. 5.7. Yeah, I mean, God, everyone has Apple. I got 17 Apple devices here. Paul, remember the days when you and I had to play a Game Boy in the back of an 87 Chrysler?
I never had a Game Boy.
Both of my kids have $1,000 iPad Pros. I bought them for us and the business, of course. I do run my photo booth out of an iPad, but my kids will still complain that they're bored with that freaking beautiful iPad and access to Disney Plus and all the games. These spoiled brats. But anyway, yeah, we love you guys. Make sure you guys are smashing the thumbs up. Paul, we're doing great. Paul, let's look at eBay, would you please? I love eBay. I've been selling.
I do too.
Paul, I've bought and sold over 1,200 items on eBay in the last 20 years.
Come on.
Yeah, I have over 1,000 rating, and I joined in like 99 or 2,000, one of those. Yeah, it's incredible. So, do you have your Y charts up for eBay, baby?
Yep, I do. Oh, I gotta switch it over. Good. Sorry.
Guys, we did hit 8,000 subscribers during the show. We appreciate you. As always, we ask you guys to smash that thumbs up and make sure you subscribe if it's your first time here. And oh, sorry, Paul, your chess coach is mocking you, of course, as always. So
what's he saying?
Oh, maybe it's chess goals. That's Matt, right?
Yeah, it's Matt. He's promoting his own business.
Of course he is. Yeah. All right, Paul. You got your charts pulled up there for eBay?
Yep. You see it?
Yeah. Look at that market cap. What is it?
Look at this. In March, it was $28. Now it's $50. It got as high as $60 a share. Market cap is $35 billion. Look at this PE, Seth. 7.
Ooh, wait a minute.
Now remember, their price to sales ratio is 3. Remember, the other ones were 18 and 50 and all these big numbers. So this is a 7 PE. Very low, 25% profit margin, 75% gross margin. This is awesome.
Great.
Small dividend of 1.3%, but it's something. So check marks on both.
How about revenue growth? Pillar number 3, Paul, revenue growth over the past 5 years.
This is all organic, 8.6 billion to 10.8.
Wow.
And I bet you in the last year, they probably did even better than that. Yeah, wow, 20% revenue. That's incredible. They're up to 12.2 billion in the last 12 months. That's incredible. Good for them.
How about profit growth? Pillar number 4.
1.725, 1.786. So barely up, but it is a check mark.
That's 4 straight check marks for eBay, Paul.
Yep. And number of shares outstanding.
Pillar number 5, number of shares.
1.2 billion down to 850. So they're taking their free cash flow and they are buying back shares. Okay.
Current assets over current liabilities is pillar number 6.
Current assets, 6.7 billion. Current liabilities, 3.84 billion. Check mark there. Nice job.
Wow. Okay. Free cash flow growth. What is their free cash flow, Paul?
All right. It was 3.4 billion down to 2.6. So an X there. Let's do the average over the last 5 years. You ready?
I'm ready. Go ahead.
So you have 3.4. We have 2.6. We have 2. We have 2.5. And we have 2.2. $2.3
is the average?
Is that the average?
Yeah, I think so.
Now,
2.3.
I will say this, guys. This is a very slow growing company, but it is the dominant one. It is the dominant one.
Are you surprised in 20 years, Paul, there really hasn't been a competitor to eBay, and I don't see one on?
Isn't that incredible? You're absolutely right, Seth. That is absolutely incredible. Like, what is the competitor to eBay? Tell me one. Like, Amazon's not even a competitor to eBay. They don't do the same thing. eBay is this auction marketplace thing where it's totally different. You know what I mean?
Hola, Nestor.
He bought me the big one. I said, oh, here's a small one. Nestor bought me my toothbrushes.
Hola.
This is Nestor. We're on a live stream, Nestor. We have 138 people watching.
Hey, Nestor. Good to see you. Hey, Paul, let's get back to it. I love you, but let's get back to eBay. You were talking about, so we came up with the free cash flow of 2.3. Their market cap is 100. So what do you think about pillar number 8 is price to free cash flow?
Their market cap is 34, Seth.
Oh, sorry. I'm on the wrong one. Sorry. Yeah, 34. My apologies. Thanks.
So my personal opinion is I like eBay sub $45. So what's 15 times 2.3? That's 35. Oh, it's about where it's at right now, actually.
35. Yeah, 35.
Yeah, so I look at it going, okay, it's probably worth what it's worth right now. Maybe it was $50. I don't remember, but I have some eBay shares and I have a lot of puts on eBay. I like eBay. Dominant in their market. They're not going anywhere, in my opinion. They generate decent cash flow. And in the last year, let's see how their cash flow has been for the last year. Trailing 12 months. 2 billion. It's actually decreasing. I don't like that very much. Shoot. Why is it decreasing? That's so weird. It's really strange. Oh, well. I still like them. I still like them as a, I still think they're a good stock. I think they're going to be worth, let me see here. Let me see what I have eBay worth according to my model. 55 to 85, depending on how big or small the margin is and all that stuff. So I do think it's got some upside potential here.
Keep going, Paul. I gotta keep going.
So anyway, eBay unfortunately hasn't sold at a price that's up. The weird part is eBay's never sold for a price that's been higher than where I have it valued at. So for it to hit my value, it have to be at all-time highs. But again, it's selling for 7 times earnings, not free cash flow. It's selling for about 15 times free cash flow, which isn't bad, but it's not phenomenal. Back in early 2020, when it was at $27 a share, I think that was a no-brainer price. It was selling for 7 single-digit free cash flow. I think that was awesome.
You know, Paul, we've seen a lot of stocks that obviously had an enormous dip during right around that same time. I feel like I kind of missed the boat on some of that, don't you? I mean, I don't know. We've been talking about a big.
I mean,
No, I know, but we had talking about a big correction. I actually moved. You remember in January, I moved a lot of my funds to cash. In fact, all cash, and I still have some in cash. I feel like I kind of missed it, and then of course other channels are talking about an enormous crash. So do I wait again? I mean, I don't know if you out there watching have had this mindset. You know, were you ready for that? Did you miss the boat, Paul? What should I think about that?
You should think about where stocks are at right now, and is that sustainable? I don't think it's sustainable right now. So if you believe that you're missing out on some future gains, hey, more power to you. Buy whatever you can. But I believe that we went from, how did we go to new highs after a major global shutdown with a major disease, and we're sitting at major GDP drop and major unemployment drop. Our unemployment rate's still double almost what it was back in January. So, you know, I still think this is all euphoria. You know, all the big billionaires that I follow, the value investors, they say this is crazy. The numbers that the stock market we see right now is crazy. It's just absolutely insane. So, you know, just be patient. Remember, stocks fell 40% in a matter of 1 month. I'm not saying that'll happen again, but if you're patient, you'll have a better time to buy a lot of stocks.
You know, Paul, Tariq brings up an idea that Facebook Marketplace might eat up eBay. Have you used Facebook Marketplace? I mean, it is growing, that marketplace. It's kind of cool, right? I mean,
yeah, I like it. I mean, I like it. It's it feels like the eBay, the poor man's eBay or something like that, because it's just like a lot of weird pictures are put in there. It's not as clean and nice. And I also think the reputation of eBay backs up all their purchases. They have PayPal worked with it. It's a little bit different, I think. You know, Facebook Marketplace is more for like the, hey, are you local? Cool, come buy this from me right now. eBay's all about, I bought things from eBay from Vegas before and from other countries before. You know what I mean? So what's the difference?
Paul, a couple of people are asking for NOK stock and NOK stock.
Nokia.
You want to look at Nokia?
Yeah, let's look at Nokia.
While Paul pulls that up, guys, obviously, again, I just keep saying it over and over. Thank you all for watching. We really appreciate your support. Paul, it's just been incredible, and all the comments are flying in. I'm trying to get to all of you. Obviously, you guys have to realize when like 150 people jump on and all say different stocks, we're trying to pick which ones we choose. And as always, we try and back our patrons as much as we can. And Paul, the Patreon page is growing so fast that I'm not always in tune with which one of you guys have just joined. So we love you and we appreciate you. Paul, let's look at Nokia right now. What is the market cap for Nokia, baby?
Well, one of the things I want to talk about with Nokia, is it Nokia or Nokia? I don't remember.
Nokia. I don't know. You're right.
Look at the stock. In 2000, it hit $60-some a share. 20 years later, if you'd seen this, guys, this parabolic rise, and if I told you, hey, guys, 20 years from now, it'll be $4 a share, what would you said to me?
You know, Paul, I love when you bring this up because every other channel besides ours is just specifically looking at these uphill climbs and just saying, go, go, go. This thing's never stopping. The Tesla Neo, it's just never going to stop. All the haters are wrong, and that this thing's going to go to the moon.
And even the ones who sit there and say, well, yeah, that's Nokia or Nokia. Okay, let's look at Microsoft. I always talk about this. Let's look at Microsoft. Microsoft is at $58 a share, and 10 years later, it was still at $30 a share, $29 a share, as low as $16 a share 9 years later. Now, remember, it fell so much before it actually started its rebound back up. That's my point about these hype stocks. They might end up being big, but there's a better price to buy them. Would you rather buy it at $16 or $50 a share, $58 a share? That's the point I'm trying to make. At $16, it was a no-brainer and everybody avoided it. At $55 a share, everybody loved it, even though it was a terribly overpriced stock. That's my point about all of these stocks. Like, just be patient. Good companies will still sell at great prices at some point in the future.
Paul, another great question from Chris Dupas says, do you also short or buy puts on overvalued stocks, especially this market, or do you just stick to undervalued stocks?
Well, I short the market. I'm short the S&P 500 right now. So I've shorted the entire market. I have shorted Amazon, Facebook, and Salesforce. I made money on Facebook and Salesforce, lost a lot on Amazon. And my current market short at SPY is in the loss right now, but I'm very confident long-term on that short.
Shall we keep going with Nokia?
Let's go to Nokia. Ready? So, $22 billion company.
Back off that mic a little bit. Just back off.
Sorry, $22 billion company.
Yep.
27 PE, so already an X. 3.65% profit margin, already an X again. So we have two X's to start.
We want our PE lower than 20, folks, and we want our profit margin above 10%. These are just the metrics, the pillars that Paul loves analyzing these companies with. So let's keep going with Nokia in terms of pillar number 3, which is revenue growth over the past 5 years, Paul.
All right, 14 billion to 26. It's a check mark, but I have a hard time believing this was not an acquisition here. But look at, even after their acquisition, it's flat. So it's still a check mark by technicality.
How about,
oh boy.
How about profit
Guys,
growth?
avoid the stock. Just avoid it.
What? You've already come to that, Paul?
Yeah, just avoid it. I mean, it's just. I mean, let's go skip to the free cash flow first. Let's just go do that. Oh boy, it's all over the place. Yeah, just avoid it, guys. Just avoid the stock completely.
Yeah,
I don't like it.
You don't like anything about it, huh?
I mean, nothing. Nothing about it do I like.
Okay. Whoops. Sorry, guys. Well, some people were asking, so there it is. How about, what is Workhorse stock, Paul? Someone said that one. Do you know what that is?
Workhorse. I don't even know what that is. Let's look. Workhorse Group?
Maybe.
Oh, boy. Oh, boy. Look at this.
What is that, Paul? Show me. Hold on a second.
Guys, no, I'm not going to look at this one. Their revenue in the last 12 months.
Scroll up a bit. Why not?
Their revenue in the last 12 months is $750,000, and they're a $2.5 billion company.
Can you tell
that then?
Well, tell. Yeah,
what?
I'm sorry, I didn't mean to cut you off. Tell people what that means when they're valued at $2.5 billion and they've only made $700,000.
No, they haven't made $700,000. They're bringing in revenue of $750,000. So I don't know what to say. If that makes sense to you, then get off this channel right now, because that doesn't make any sense to me. Like, it generates $750,000 a year in revenue. My company does $20 million in revenue. According to the same metrics, then my company should be worth $75 billion. Then what am I doing on this channel if I'm worth $75 billion? I mean, this is ridiculous. Sorry, Workhorse, pass.
Paul, we had Etsy on our mind. Would you like to look at Etsy? Or should we look at something similar, Shopify, from one of our patrons?
All right, let's look at Shopify. By the way, I want to make note, this is a record. This is a record number of people we've had live on the podcast on this channel before. I just saw 154. That's awesome.
Yeah, thanks, guys. We appreciate it. And make sure, listen, now, folks. Paul's going to get a little salty here after the show when he sees 154 and only 88 thumbs up. Now, we're fine with the thumbs down, but go ahead and make sure you tickle that thumbs up, because by tickling the thumbs up, I assure you, by tickling the thumbs up, you tickle Paul's inner child. Really. I mean, that's what I'm asking for. It's just that little cute little smile. Okay, Paul, keep going. I'm sorry.
By the way, I had to cancel a chess lesson with Matt today because of this live. I totally forgot that because of the change in time zones.
Oh,
I
yeah.
booked it the
Okay.
wrong way. Oh, no, it wasn't because of that. It was because of the videos we have to do. We do the extra videos at the beginning. So,
Okay.
All right. We're at Shopify, guys.
Shopify. Here you go, Paul.
$140 billion company. 140 billion.
140 bill. Okay.
It's tripled since April and March.
Tripled.
Look at this PE ratio.
Oh my God.
737. Folks, we want to be at 20. So this is 37 times higher than we want to be. It's a fast growing company, so let's check it out.
How about
25% profit margin. It's a check mark
good.
there.
That's good. We like profit margin that high. How about revenue growth, Paul? How are they doing?
Revenue growth is huge. 205 million to 1.6 billion.
Wow. Profit growth is pillar number 4, baby.
An X, they lost 18 million. Now they lost 125. They're losing more and more money every year.
How about shares?
Oh my gosh. They've doubled their shares outstanding. 61 million to 113 million shares outstanding. So now, guys, the share you owned 5 years ago is now buying you half of what it bought 5 years ago. You get half percentage of the company than you got 5 years ago. They are diluting the heck out of you.
So, folks, let me just, Paul, if you're viewing and if these numbers confuse you, you want to be investing and you may be a first time watcher or a new subscriber, like I assure you, if you just keep watching us for some months, like my 10-year-old can see a high PE. George, see that, Paul? He's already saying, bye-bye, rest in peace. This company's dead. I'm over it. Like, guys, it does take some time. We're not expecting you to jump on our channel. And I know Paul is swiping on Bumble right now, but I'm really being very heartfelt in that this takes some time. You got to watch some videos to learn. And I assure you, you can get your finances in your hands and learn to stay away from some of these crazy ass stocks, Paul. This is crazy.
Yeah, so Shopify, guys, I think Shopify is great, what they do. You just got to wait for them to stabilize a little bit in their revenue and cash flow. I mean, there's no reason to go further from just saying that. So trailing 12 months, they're up a lot, 60%, 50% or something like that. No, 60% revenue growth. And they made money. They're up to profit now, $200 million, but $200 million on $140 billion. I mean, that's sick. Nice job. Let's see if my sheet will even give me a price for them. Yeah, it doesn't even give me a price for them because they don't have enough revenue over a long period of time. So, guys, it's tough for me. I would sit there and say avoid Shopify. Wait till it settles down, generates more revenue, more consistent profit, has a plan to grow. Do they even have free cash flow? Let's even see if they have free cash flow. Barely free cash flow, $8 million. $8 million. So they're currently selling for, let's see, 1,000, 10,000, 20,000 times free cash flow. 20,000 times. We want 20.
What does that mean in layman's terms, Paul?
It means if you bought, based on the last year, you'd have to take 20,000 years. If the last year to repeat over and over, it would take you 20,000 years to get your investment back. But again, they're growing a lot. So there's a lot more potential for that to increase over time. It's just, how does it go from 20,000? How does it grow 10,000 times and justify your return? I'd say just wait. There are other good options out there that generate more cash flow for you.
My wife just chimed in, Paul, because of course my whole family watches as you talk. They're all learning from you. But that is a shameless plug is I do sell my DGF on Shopify, Beth. So I own a small company here in Cleveland. It's a Miracle Power Products is the company, and we sell DGF spray. It's a graphite spray, and it's on Shopify, and we love it. I love what Shopify does, Paul. The system is very intuitive. It's very nice. It's very easy to sell things and make money. So I do love that. So,
listen, it's great. We use it too. We use it for our businesses as well. It's awesome. It's just, it's not a stock that I want to own right now.
Paul, this is an interesting one. Someone just requested this. I don't know who you are. I'm sorry. There's so many comments coming in. But Paul, someone asked for QSR, which is Restaurant Brands International.
Okay, let's check out what they own. Oh, wow. Look at that drop. You see that, Sethy?
Let me pull up your stock here. There you go. Look at this. Yeah, look at that.
Okay, Restaurant Brands. The consolidation of Burger King, Tim Hortons, and Popeyes Louisiana Chicken. Do
you eat Popeyes, Paul?
I love Popeyes. I don't eat it, though. But when I have done it, it's been awesome.
We haven't. Someone else brought up the idea maybe we should look at the Burger King or Wendy's. You and I, how many times have we gone to Wendy's to get? I mean, hundreds of times.
A ton of times.
Like if you and I get,
there's one like a half mile from the office.
yeah, but I mean, just in general, like if I leave the house, I'm going to go to Wendy's at some point during the day. I just freaking love it. So, all right, let's look at this. This is Restaurant Brands International. Paul, what's the market cap, baby?
Okay, 18.4 billion. PE of 33, so it's higher than 20, so that's an X there. But the profit margin of almost 11%, check mark. And they have a dividend of 3.4%. So what is that dividend? It's 500, let's call it 600 million to be conservative. $600 million a year in dividends. So we want to make sure their free cash flow can support that dividend.
Let's look up revenue growth, which is pillar number 3, Paul.
4 billion to 5.6, and it looks pretty consistently growing. So that's a check mark there.
Nice.
Net income 375 to 643, another check mark there.
Very nice. So the PE is not so good, not terrible, 34, and we have 3 check marks so far. How about number of shares, Paul?
Well, oh yeah, number of shares. I'm sorry.
Yep.
Number of shares outstanding. How about number of shares outstanding? It's actually an X from 203 million to 268. I don't like that. And here's the other thing. Here's something interesting. Average diluted shares outstanding. It's usually never this big of a difference. So what does this mean? This means that if every single possible share could be executed and brought into shares, you would automatically be diluted again in half almost. That's not a good thing. I don't like this very much at all.
Okay.
So even if the company sold at a price I like, that's a big red flag for me.
Current assets over liabilities?
2.7 billion versus 1.6. So check mark there. And free cash flow. Remember, we need 600 million in free cash flow to justify the dividend. Free cash flow by year. Ready? Oh, so wait a second. First off, 1.2 billion to 1.4 billion. So check mark there. So 1.1, 1.4, 1.05, 1.35, 1.2.
Average is 1.2.
Okay, this is not a fast-growing company. The dilution really concerns me. So this is where we try to determine what kind of multiple we go off free cash flow. The dilution is a problem.
Let me slow you down real quick, guys. Just I like to bring people back around because we lose people on this one. So what we did is we found the average free cash flow of the company, which is 1.2 billion, right, Paul? Billion.
Yes.
And then
1.2 billion.
Our pillar number 8 is price to free cash flow. So we take that number, we multiply it by some number to determine the market cap that we want to pay for this company, and then we compare that to the actual market cap that shows the value of the company at the moment. And then we can see whether we want, if this company is overpriced or undervalued, underpriced. Paul, what do you think?
So it actually seems underpriced because it's only selling for 15 times free cash flow. But the issue I have is those diluted shares. That's the issue I have. It's actually a reasonable free cash. Let's see how the last 12 months of free cash flow has been. Well, it's only been $1 billion. I mean, it's still not terrible. Yeah, I mean, I'm stuck on this one. If it wasn't for those shares outstanding, always increasing and so much dilution, I'd be in favor of this one. So it all depends on what the chances of those shares being executed are. And they stop freaking issuing more shares out, then it's actually not bad. So, I mean, it's not a terrible stock in terms of from the 8-pillar perspective. It's just not bad. It's just those number of shares outstanding are just awful.
Paul, folks, we just analyzed QSR stock, which is Restaurant Brands. Paul, people are going nuts for Square. Why don't we look at Square stock?
Well, wait a second. TELUS. Somebody keeps asking about TELUS. What's TELUS? Let me look at TELUS.
Okay, go ahead, bub. Yeah, people are asking. I don't know what that is. What is it?
Telecom services in British Columbia. TELUS is one of the big 3 wireless service providers in Canada with its 9 million mobile phone subscribers nationwide, constituting almost 30% of the total market. Okay. So big dividend. Yeah, let's look at it. $25 billion company, 25 PE, so X there. 7.75% profit margin, X there. So not great on either one, but that's okay. But almost a 5% dividend yield, which means 1.25 billion being spent on dividends every year.
Nice dividend though, huh?
Nice dividend.
Revenue growth is pillar number 3.
Check mark, 9.7 billion to 11 billion.
Nice. Profit growth?
1 billion to 1.3 and very consistently growing. So check mark there.
Number of shares outstanding is pillar number 5, Paul.
Marginally lower, 1.206 to 1.204. but it went a lot lower and then started to increase. So I don't know what they're doing right now. Let's see how they're doing in the last quarter. Yeah, they're increasing the number of shares outstanding. They are definitely issuing more shares as the quarters go on. So I don't like that a lot, but it's still technically a check mark, even though it's not really that good.
Pillar number 6 is current assets over current liabilities, Paul.
Current assets, 3.265 billion. Current liabilities, 4.1. That's an X. I think it's the first one today we've seen with less current assets and current liabilities.
Yeah, that doesn't happen often.
It doesn't happen often. And free cash flow, my favorite one in the world.
Free cash flow growth is pillar number 7.
Oh boy. It is positive. It is a check mark, but they have like no free cash flow in the last 5 years. So it's a check mark for the free cash flow growth because they went from losing 800 million to basically breaking even. But in terms of the average over the last 5 years, it is definitely, they spent a lot of money on capital expenditures, guys, a lot of money. So you need to figure out how much of these capital expenditures are growth capital expenditures versus maintenance. Sometimes in their annual reports, they will mention that because maintenance ones are the capital expenditures they need in order to continue operating their business as is. The growth capital expenditures are the capital expenditures they spend to grow the business, which is a lot different. As an example, in our properties, when we replace a roof, that's maintenance capital expenditures. When we remodel a unit to get a higher rent, that is growth capital expenditures. So the same thing with companies. This is a tough one. I'm going to avoid this one unless I need to understand more about how much of their capital expenditures are maintenance versus growth. But the thing is, they're not even growing that much in terms of revenue. So, oh boy.
Paul, Benjamin, one of our OGs, Benjamin is saying that they have a nice dividend that they can't actually afford, right?
That is correct. Their dividend is not affordable right now. They don't have the cash to do that.
Paul, why is your screen going like that? Look at your...
Because it keeps going to... I'll just do that. There we go.
Sorry. Great, Paul.
That's okay. You're fine. It's my fault.
Okay. So yeah, this is a no on TELUS at the moment, right, Paul?
This is a no on TELUS for sure.
And I was just about to say, what is your target price on this company? But it sounds like with all the X's in the 8 pillars, you're not touching this company, right?
Yeah, I'm not touching it right now. I would just prefer to avoid it.
It's funny, Paul. Let's bring it back. Let's slow down a minute because Tank, our dear friend in Germany, just asked. So, who are the winners of 2020? Obviously, it's a funny question. There are tons of companies that just skyrocketed this year. Amazon was one. We did a podcast very early on in the year that my 72-year-old mother in her retirement savings, her financial planner got her into Amazon. And we were both pretty upset by that, at the time, an overvalued stock. And she did really well on it, as a lot of people did. Obviously, you, as you've admitted, have been quote unquote wrong on Tesla for a few years now. So it's a great general question, maybe bring it home a bit is like, what happened this year and who are the winners and how is that changing or not changing your investment strategy moving forward?
Well, remember, my view of winners is a lot different than most people. My view of winners are how many opportunities we have and companies are selling, seeing their path forward. Stock price going up, Tesla's the obvious winner. Netflix, every major company has gone up a ton, but I look at it totally different. I look at it saying, there's a lot of opportunities for investors in companies like CCL and Southwest Airlines and things like that. So it just depends how you look at everything. Everything's perspective. What can be good for one person might be bad for another. For example, if stocks all of a sudden fell a lot this year, S&P fell in half, I'd be a big winner. Everybody else would be a big loser. So it's all a matter of perspective. I don't know how to answer that question without understanding what winner and loser meant. If you just meant stock price, then Tesla, I think, is the big winner because that stock is going through the roof for no apparent reason whatsoever, which is incredible.
Yeah. Paul, Husky's bringing up that we sort of prefaced H&R Block earlier in the show. We do have some videos coming out, guys. We did just look at H&R Block. If you've been following along our channel, I invest following Joel Greenblatt. And Paul, you've advised me to sort of follow some of these companies, but Joel Greenblatt wrote the book, The Little Book That Beats the Market, and he lists some currently undervalued companies. And we looked at H&R Block, and it was incredible, the pillars of H&R Block, Paul. It was really phenomenal. In fact, we came up with a market cap that we wanted to pay, which is currently double what it's currently at. So just recap H&R Block one more time, Paul.
So HR Block took a big hit because of two reasons. One, people weren't allowed to walk into stores for the first quarter when taxes ended. And two, the government postponed when taxes would be done. So they took a big hit to their revenue and profit. But right now they're sitting at a revenue and profit multiple and free cash flow multiple that's insane. And I don't see with the vaccine, I think they're going to get back to normal very quickly. I was a big fan of it and I'm doing more research on it and Mo's helping me out. I'm a big believer in that. And I think to myself, okay, well, I think this will be okay for a while. So let's figure it out.
Paul, I usually do reward some people who are pretty adamant about what they're saying. And someone brought up, Augusto asked, iShares Gold Trust. Is it ETF? Have you ever heard of this? I mean, what is
iShares Gold? I mean, it's just basically buying gold. So if you believe in gold, that's what you buy it. I buy the refineries or the whatever they're called, the GDX and GDXJ.
Those are the refineries, right? Yeah, I hear you.
What's it called? Mushroom stocks, MMED. I just looked that one up. It's got no revenue. It's got no revenue, Jennifer. So I just ignore it.
Why is that, Paul?
Why does it have no revenue? Because they don't sell.
No. I mean, why do you automatically ignore? I mean, for some of our new viewers, why?
It's a $1 billion company with no revenue. I have no desire to even try to figure that out.
Yeah, folks. I guess the point, and I had to learn this over the past couple of years too, is we're not really, as much as we're trying to find companies we can invest in, it's patience, right, Paul? It's just talk about that, the mindset and patience of investing. You say it's key.
What we're trying to teach you that everybody gets on board with is there are always good times and bad times to buy stocks. There's 10,000 stocks in the U.S. Your goal is to find 20 or 30 good ones. That's one in every 500 of them need to be a good one. You will find that. What we're trying to teach is how we can all learn together to figure out how to find the good stocks and buy good stocks that we can be patient about, not reacting to what the market does, not reacting to what people are saying, do our own analysis and believe in our own analysis. That's what's important here.
Paul, two of our patrons, John, I see you, I love you, and Robot, I have wanted to look at Dow Chemical. Can you pull up Dow on your Y charts?
Yeah, let me pull it up real quick. It's just DOW, I see.
Yeah,
I see.
Dow is important to me as well, Paul. I do sell my graphite spray to Dow as well. So this is interesting. Let me pull it up on my end. Again, if you're watching, a lot of these are requests, folks. So we don't know much about some of these companies, and frankly, sometimes it doesn't matter. We want to look at the financials, right, Paul?
Yeah, so this one, they're located in Michigan. They're very diversified with $40 billion market cap, $38 billion in revenue. But boy, they've lost $2.3 billion in the last year. And if you look here, Seth, without going into the 8 pillars here, their revenue is down a lot over the last 4 years, and their profit is down a ton. What's the reason for that? I don't know. And they keep losing more and more money. I don't really like that very much. And this is not good. Let's see their cash flow.
Yeah, John's saying they do have a good dividend, but I wonder if they can pay for it, Paul.
Well, they had a good free cash flow last year of $4 billion. Let's see trailing 12 months free cash flow. Oh, wow. So maybe they just had a big write-off at some point. So when there's a big difference between profit and cash flow, a lot of times it can be a big write-off that they had. So let's see. Look at this. A $4 billion write-off here, a $3 billion write-off here. Their operating income is still down a lot though. 4.3 billion down to 3.5 billion. So this is a tough one, guys. Like this one, I mean, their revenue down and they're selling for 40 billion on 38 billion in revenue. It's not bad. If they had a reasonable margin, but their gross profit margin is only 14%. So how much can they possibly make? 400, I don't know. I think I'd avoid this one. I just don't see because look at this. Their bottom line profit margin can't be higher than their gross profit. So let's say their gross profit is 14 and their profit margin is 3%. 3% of 38 billion is $1 billion, right? And they already paid $2 billion in dividends. It just doesn't make sense to me. Now, I don't know why this is without doing more research to figure out why that is. But these numbers, this is why I do the 8 pillars. This is how they came up with these 8 steps. I sat there and it tells me a story. The story here is the company's revenue is going down. That could be because of the chemical commodities that are fluctuating in price. Who knows? But the revenue is going down. The profit's going down. Free cash flow is increasing. Why is that? So I have to understand why that is. But without doing more research, I can't really make a decision on Dow. I can't even make any advice on Dow.
I hear you. I'm here. So many requests, Paul. I'm trying to get through them.
Well, we said we were going to go an hour. It's been an hour and 12. So why don't we stop there?
Yeah, let's do that. Folks, we love you. We will be live again on Thursday. We will be alive next week on Tuesday and Thursday as I join Paul in his Mexico mansion on the cliffs of the Pacific. The Pacific waters hit the shores just below Santiago Bay there, Paul. And we will be having a Patreon-only live session as well. You guys are incredible. Paul, you must be tired. I'm tired. Just doing an hour is quite taxing on these old bones, you know, Paul. So,
and since we started the live stream, we got almost 20 subscribers, which is great.
Very nice, guys. Again, thanks for everything. We're shocked at the number of subscribers are coming in. If we didn't get to you, listen up real quick. If you're still on, a lot of people are asking about videos. We've done them before. If you go in, subscribe, go in and search our content for keywords. You can find a lot of these. We've been doing this for 2 years, talking about some of this stuff. And so there's a lot of info on there. And if, yeah, Paul, some people just jump on and write the word Tesla. And we've done so many videos on them. If you're a fan of Tesla, if you're a fan of Tesla stock, you're not gonna like our Tesla videos, Paul. But we love the company. I have a Tesla in my garage right next to me. But yeah. So anyway, and Owen, and yeah, he's great. Yeah, 2 thumbs down from Owen. Owen, we love you. Thanks for being on, guys. All right, fellas, and ladies, Paul. Yeah, ladies, of course. Thanks for following along. We love you guys. You guys are incredible. And we will check you on Thursday at 1 and a video every single day. And Paul, we also put out videos at 7 o'clock. So many videos, guys. See you. Thanks, Paul.
Peace.